Hello everyone, it's Tuesday and you're watching Within the Frame. I'm Kim Bo-kyung. South Korea's central bank held its key interest rate steady for the second straight time on Tuesday, keeping the benchmark rate at 3.5%. The second rate pause in a row comes after the BOK delivered 7 consecutive interest rate hikes since April of last year. Now, back-to-back rate freezes are raising expectations that the BOK's most recent decision is a hint that its hawkish monetary policy aimed at cooling inflation is coming to an end. But has inflation been tamed? And considering the disclosures by several companies regarding consolidated operating profits for the first quarter, could we say an economic slowdown is actually on the way? Now, for an in-depth analysis, we welcome Oh Joon-seok, Dean of Sookmyung Business School. Professor Oh, welcome.
Good evening.
And we also have Trinh Nguyen, Senior Economist at Natixis, on the line as well. Trinh, it's good to see you again.
Thank you for having us.
All right, first question to our Professor O. Now, the Bank of Korea was widely anticipated to freeze its benchmark interest rate for the second straight time, and this morning it decided to keep the key interest rate unchanged for now, as widely expected. Now, what were the reasons behind the BOK's decision?
Monetary Policy Board of the BOK decided, as you mentioned, to hold the benchmark rate steady at 3.5%. It might be understood that the rate freeze does not necessarily mean an end of monetary tightening cycle. It's appropriate to check whether the base rate needs to rise further while assessing the pace of inflation slowdown. The BOK began its rate hike ever since August 2021. It has since raised the benchmark rate by a combined of 3 percentage points. Successive rate increases have generated fears that they could hurt the economy, already faced with uncertainty stemming from the global recession and slumping export, which is the main driver of Korean economic growth. Now, Korea's export fell mainly due to a weak semiconductor market. It is forecast that inflation will continue to be above the target level of 2%. The benchmark rate has been raised up to a restrictive level, and future monetary policy decisions will be made after closely analyzing not just inflation, but also economic and other various factors, including politics. In this respect, it is expected under the assumption the Fed's rate is 5.25% or below, the Monetary Policy Board of BOK is highly likely to keep the rate unchanged afterward and start to cut the rate in the year end.
Right, I see. Now, Professor O, let's dig a little deeper. The main reason behind the rate hikes up until now was actually inflation, And recent figures, however, show that inflation has passed its peak, with the consumer price index for March showing prices have increased by 4.2% compared to the previous year, which is the lowest since last year, March. Now, could we say that we almost have inflation under control?
Not yet. Just we could afford to have time to take a short break. As you mentioned, Korea's inflation fell to 4.2% in March from 4.8% in February. Although the recent slowdown or price increase have led to the rate freeze, today's freeze also came amid growing concern over the economic slump based on various negative impacts. And the economy contracted in the first quarter of last year, and the current account in the balance of payment posted a deficit for 2 straight months in January and February for the first time in about 11 years. Energy prices soared and exports have been sharply shrinking in the face of less demand for semiconductor amid global recession worries. Korea is also facing uncertainty in the banking sector, stemming from the recent collapse of Silicon Valley Bank and the global bank Credit Suisse. One thing we could count in is the fact that today's freeze comes even though the rate difference with the United States is widening. Higher rates in the United States are feared to prompt money outflow from Korea, thereby weakening the local currency against the dollar, and exerting upward inflation pressure by making import more and more expensive. In brief, as long as the U.S. keeps the rate freeze, Korea could have time to take a breath, not to increase the rate. But because the possibility of inflation falling to the 2% range by the end of this year is also great, it is a slim chance to drop down the rate by the end of this year either.
Right, I see. Now, Trinh, our Professor O says that we are not just there yet when it comes to the inflation. And adding on to that, the recent decision by OPEC plus nations to cut oil production could complicate the situation, exacerbating inflationary pressures. How high do you see oil prices will be, and how would such uncertainty regarding oil prices affect future BOK decisions at rate-setting policy meetings?
Absolutely, I agree with the professor. We shouldn't be complacent about inflation because what's really driving headline inflation down is we get a help from commodity prices, which have eased significantly, right? Not to forget that we're also having in the second quarter, KEPCO is being forced to pause its utility hike. Now, it's not very certain that, and one of the key reasons why commodity prices weaken a lot is really China recovery is much slower than expected. We have CPI data out of China today that was very, very weak, showing the demand side of the Chinese equation for growth is very weak. So as a result, we expect more support to come from China, which means that you may have demand gradually rising, and that's one uncertainty. So we have demand potentially improving. The second aspect is that this oil cut, which will actually reduce supply in the market with demand likely to stabilize, and oil demand is quite inelastic in the short term. So we have also, in addition to this, if you look at food prices recently, they have actually increased quite substantially. Today, India says that its monsoon season is fine, but actually the forecasts have been quite questionable. So the volatility in weather events can cause an uncertainty, not to mention the fact that for Korea, core inflation remains very sticky. And this is also a sticky point in the US as well, because we're waiting for US inflation data and headline is expected to fall, but core is expected to accelerate. And the uncertainty regarding Korea is twofold. One, we have the households and the corporate sectors not doing well from the income perspective. It puts the pressure on government revenue. And so far, Korean inflation, even if it has been very high, leading the BOK to raise rates, has actually been supported by fiscal policy. So the question is whether or not we can continue with that fiscal support moving forward, and KEPCO not raising prices in the second quarter is part of the support, as well as tax benefits and so on and so forth.
Right, I see. It seems like there are many uncertainties that we need to take a closer look at in terms of inflation fighting posture. Now, Professor O, a Fed's interest rate isn't a thing BOK can overlook that easily. So let's move on to the Washington situation. The U.S. labor market seems to be cooling off amid the Fed's year-long rate hike campaign, as it added just 236,000 jobs in March, coming in below expectations. However, some say it is very much still strong, giving the Fed room to hike rates again. Now, what is your takeaway on this?
Job creation is of great importance, especially in time of economic recovery, not to mention of income inequality. It's very difficult to handle this situation. I would say the possibility of rate hike would be very slim for the moment. While Jerome Powell had indicated that the central bank may have to take a more aggressive path to tame inflation, fast-moving banking crisis thwarted a more hawkish move. Unless the financial system remains stable, aggressive rate hike could be a poison pill. Rate hike in finance are blunt instrument. They only work at cooling price pressure by slowing demand across the board. When the Fed take rates, it could have a grave implication for deflating purchasing power, shrinking job market, and the U.S. economy. Now, yes, game changer will be banks within the U.S. and abroad. The recent banking crisis may underscore even more to the Fed. It's time to wait and see. A quick reaction in the market, they slightly increased their expectation for inflation with a 3.3% rate pegged for this year. Unemployment rate was lower a notch to 4.5%. A pause in hiking rate may be around the corner. And the debate about when to stop raising interest rate could be picking up soon.
Right, I see. Now, Trinh, on April 12th, that's just tomorrow, Washington will see the consumer price index data for March. Now, what are you expecting, and how will the CPI figure affect the Fed's decision in early May?
I think what's very clear here, very similar to South Korea, is that headline inflation is cooling, right? But services remain quite sticky. And let's not forget that the Fed target is not being reached yet. What that means is moving forward, very similar to Bank of Korea, is that we know it's very likely we have reached terminal rate. Whether or not the Fed will hike by another 25 basis points is a question mark, but frankly speaking, it is reaching the end. The big question mark is that markets have actually priced in quite a lot of cuts. Is that going to materialize as soon as markets would hope? I don't think so. And I think that's why the inflation figure is quite important, particularly core inflation, which central banks tend to look for because they look past the volatility of food and oil prices. And I think core inflation will keep interest rates at elevated level at the very least in the short term. And I think that is an important figure to watch because the Fed, while it may place financial stability and a slowing economy ahead of fighting inflation, which has yet to reach its target by a long shot because real rates are actually still negative. But at the same time, what this means is that we're still not going to get cuts anytime soon. And that's, I would conjecture, is a very similar case for the Bank of Korea. While we might rejoice that the pressure cooker is easing, we're still not going to get rate cuts from BOK anytime soon, very similar to the Fed. And at the very earliest, it's the end of the year in 2023. And let's not forget, we're still only in April.
Right, I see. So the cut would not come anytime soon. Now, Professor Oh, the interest rate gap between the Bank of Korea and the U.S. Federal Reserve already widened to a new high of 1.5 percentage points for the first time in almost 22 years, following the Fed's unsurprisingly dovish rate hike of 25 basis points last month. Now, if the Fed goes ahead with another rate hike, even a dovish one, should we be worried about capital outflow?
I don't want to talk about the textbook theory such as the interest rate parity theorem, but big yes. In that case, we should be worried about their direction, regardless whether it is a dovish or hawkish. When the balance of interest gap between the United States and Korea failed, exchange rate would be sold up. It will trigger capital flight from Korean capital market. In preparation, the Bank of Korea has no other choice but to increase interest rate in advance. This is not only confined to the Korean case, but the rest of the world should follow the case. If interest rates keep going higher in the United States, not no matter whether the gap is dovish or hawkish, the world will inevitably have to try to catch up. This is why all the world pay attention to the Fed's decision in May, whether the Fed will maintain its top interest rate hike or give a signal, an end to the tight monetary policy. Economists have long expected the Fed would likely stop raising interest rate at some point in 2023, but where rates peak, a level known as the terminal rate. By the way, will the Fed move? The failure of Silicon Valley Bank would be a stabilizer, at least for the moment. What is needed at this moment is the speedy emergency action from the United States federal government, and central bank would moderate its tightening steps, holding on, keeping balance in the financial market.
Right, I see. So I guess we'll have to see what kind of decision Fed will make early May. Now, shifting gears a little bit here, Trinh, due to worries over a possible economic slowdown and the impact of high interest rates, many companies are posting earnings shocks, and Samsung Electronics was not an exception. The company disclosed on last Friday, that is, an estimated consolidated operating profit for the first quarter of some 600 billion Korean won, or around $455 million US. That's a sharp decline of nearly 96% from the previous year. Now, why such a sharp decline in operating profits?
Korean firms are facing higher costs, right? Higher inflation, higher interest rates. And Samsung Electronics face another one, which is highly exposed to a very cyclical sector, which is semiconductor. It's the largest maker of memory chips. And as you know, demand for that was quite high during the pandemic. Prices rose, but as a result, investment rose, and there's a huge glut. Now, companies are liquidating their inventories, so they're not purchasing more chips. And so the largest maker is facing that cyclical downturn as prices fall sharply, and prices have fallen about 70%. So the decline of Samsung Electronics reflects the downfall of the cycle, and I think it reflects it much more than other sector because that is the core of its business. Now, I think that if you can overlay that to the larger theme and looking forward, the two key points is that this feeds into what we have seen in exports, which have declined quite sharply in March, and also even the first 10 days in April, the chips continue to be down. But Samsung has always said that it will cut production. So other chip makers are quite happy about this because it means that ultimately, eventually, inventories will run out, will be clear, and that you will have an improvement at the very least from the liquidation of inventory if demand doesn't rise fast enough, and eventually at the latest it will rise towards the end of the year. So the end is in sight, but it's not yet there yet. But clearly this is a reflection of a company that's quite concentrated in a sector that's on the downturn, and it also reflects Korea's dependence on this particular company and this particular sector, and why South Korean exports are on the downturn. Now, I want to also highlight the fact that it's not just a cyclical story for South Korea. So Korea is not only facing a downturn of the cycle on a cyclical basis, but also structurally facing competition from industrial policies across the board, from China trying to be more self-sufficient in chips. If you look at the trade deficit with China, it's not just driven by the downward demand of China because of cyclical sectors, but also structurally, also the U.S. semiconductor bills, and so on and so forth. And as a result, I think this sector will also be supported by the South Korean government, as indicated its continued commitment to investment and continued support through tax support. So it's not entirely negative. There is some silver lining you can take from this.
Right, I see. Now, Trinh, one more question. Meanwhile, LG Electronics operating profit looks like surpassing that of Samsung Electronics for the first time, projecting an operating profit of 1.5 trillion Korean won. Now, what led LG Electronics to post its earnings surprise?
Well, they both are in the consumer electronic, except as I mentioned, Samsung is really at the core, is really semiconductor. So LG exceeds expectations, but it's still down on a year-on-year basis. And one of the key reasons there's a silver lining to the energy crisis is that there's higher demand for more efficiency products. And I think this is where one of the areas that LG has pivoted towards. It's also pivoted towards of the green energy transition as part of its automobile electronic parts. So it does help. That is not as concentrated as Samsung. And there is some silver lining to it, but it doesn't mean it's dragged down by the whole downturn of the consumer electronics cycle, which affects everyone from Apple to Samsung Electronics. It's just that for Samsung, the decline was quite substantial, right? We're talking about 96% decline. So it's easy to exceed such an underwhelming performance.
Right, I see. Now, Professor Oh, I believe this will be our last question because we are running out of time. Now, though LG Electronics were an exception, most companies have reportedly struggled posting earnings shocks. And considering the possibility of an economic slowdown looming, some expect rates may pivot sometime this year. And I know that you have already said that rate cut is not going to come anytime soon, but I need to ask, what is the likelihood of this happening?
LG Electronics reported better than expected profit in the first quarter as strength in its automotive business and cost-cutting efforts for the weakness in its home appliance business. LG Electronics said the company's efforts such as reducing shipping costs and restructuring its business portfolio to preemptively deal with slowing demand amid the economic uncertainties helped it navigate various challenges. This includes core competence of LG Electronics, not easily be changed depending on the financial market conditions, depending on the rate changes. As the Korean economy aimed at R&D hub in Asia, despite the evaluation of being overheated, reusable battery stocks strengthened the expectation for the benefit from the IRA, LG, and other semiconductor industries contribute to sustain the growth momentum, even though the financial volatilities.
Right, I see. I'd like to ask more questions to our experts, but unfortunately, this is all the time we have for today's edition. But thank you, Professor Oh, and Trinh, of course, for your insights and letting us to better understand the hard economic sector. We really appreciate it.
Thank you for having me.
Thank you for having us.
All right, this is all for Within the Frame tonight. We'll be back tomorrow with more in-depth stories. Thank you for watching, and goodbye.